Good morning, everyone. This is Brad Matheny. Today's the 13th of January. Now, a couple of very important things to go over with you. Number one, we have had a dramatic shift in the market with Friday's close. I'll come back over here to this chart and go to the SPY, get rid of those at the bottom. And I want you to see this is weekly. I want you to see this dramatic shift that we had taking place last Friday. Now, it didn't happen in the QQQ, but it's clear as day to me on this daily chart that we had a breakdown of this lower level. Okay. Uh, this is what I want. Make it 4 and bright red. So what we've got here, ladies and gentlemen, is, we are failing to make new highs. Now, in the past, I had been talking about how, we would likely see some sort of a move back up into the inauguration, which is actually more right around this area. So let me clear this and kind of redraw this, moving back potentially up into this inauguration area. I still feel that that is a potential. And yesterday, as I was doing my weekly research and videos, which is actually Saturday and Sunday for my subscribers, I pointed out the fact that we could get rejection here off of this low and roll up down off of this lower gap area. So you need to watch this area, this 576 area on the SPY, as a potential gap fill area, potentially rolling up into the inauguration. But generally, I want to try to highlight a couple of things as to why we are now moving into a very volatile, dangerous period for the markets. So, someone once commented about how the SPY cycle patterns don't take uh, into consideration bonds or Fed funds rate or anything of this nature. In a way, they do. So this is what I call my easy money index. It is a right here at the top. It is a combination of a number of things. It's number one, a custom index. Number two, it runs a custom script that I built, Pine script that dictates direction, and it's actually visible here in the SPY cycle patterns over here as the daily, weekly bias. So when you see the daily, weekly bias representing long or short, it's actually this data. I visually take a look at it and interpret. There's a rule. You can see that we are long as of over here. This is where we flipped to bearish back in middle of November after the election. And the reason it's inverted right now is because of specific rules that deploy as we move forward. Now, this move higher, also reflected strong uncertainty in the bond market, and particularly from investors pricing in excessive risk. Basically, the global debt market is going to the U.S. and other debt markets and saying, "Hey, either number one or A, we don't believe that you have control of the markets and or your debt situation, or number two, we believe there's excess risk that you're not telling us, so we're demanding increased yields, increased payout in order for you to borrow our money." And that's what's happening here now. In the long run, ladies and gentlemen, this is what it looks like. This is what this big swing looks like going forward. And this is the highest level we've seen in 3 decades, 2 3 decades. The global financial crisis that sent the world into a tailspin peaked out at around 210, 220 back over in this area. And you can see this post COVID. So we were in a contracting phase in 2016, 17, 18. Remember, in 2018, the markets went through that extended kind of a sideways contraction right back over here where I'm pointing. That's when the Fed was rallying rates. And then, of course, by mid end 2018, the Fed suddenly made a decision that, whoops, we gone a little too far. And they began decreasing rates down to about 1 3/4, which gave the markets a bit of a reprieve. And then we rolled for about a year into a growth phase. You can see the growth phase here. Okay, that's an upward trend is a growth phase, downward trend is a contraction phase. And that got us into COVID right here, which then the Fed decreased rates even further, sent us into this massive growth phase, the highest we've seen in forever. And since basically the top of 2020 here, we have been in this mild contraction phase. Now, when I say mild, you need to understand that, getting above this 800 level here, or let's call it 900 to 1,000, that's really excessive. Up in this area, here, I'll draw real quick. So this is really excessive. Up in this area, just really quite excessive. Being down below like this area, 800 to 1,000, this is more normal range, particularly going back since 2008, 2009. So moving into this contraction phase is very normal through a rising interest rate type of environment. That's very normal to get down into this type of contraction phase. Now, getting below this blue level is one of the first signs of really a warning. And getting down to this level would mean that we're getting really into a very deep recession. So now we are on our way down. Let me come back over here, show you where we're at, and we are on our way down to that pink level. We're at 139.04 on this move. We're well below this 240 level, what I call the blue level. That's back over here, the 240 level. We're 139.04, headed down into this pink level, this lower purplish level. And again, this is what's putting pressure on the markets right now. That's why last week, as we saw this rally, I didn't put too much pressure on it because we had not seen this big breakdown extend. As of last week, I had indicated I thought that we were going to get a rally back out of this and lighter yield pressure. It didn't happen. And when we got this breakdown back over here, right here, where this red line is, oops, indicating a big breakdown in the markets, this was technical confirmation for me right there to begin to start to scream, or at least visually confirm that we have a breakdown. So at this point, technically, we have a number of things playing out here. And this is what I want you to understand. Let me come back here and find it. Number one, we have the bond pressure playing out that was excessive, but hadn't really addressed the market yet. In other words, we hadn't seen any big breakdown in trend. And until we saw that breakdown in trend, this bond pressure could be temporary or fleeting. We hadn't seen a real breakdown in the money supply index, meaning the easy money index. And we did over the last 3, 4 weeks. But again, no big breakdown in the SPY. Generally, as I mentioned to you, the trend had been bearish on biasing because of this indication, because of this custom indicator. And we had been working through this rally phase that never really materialized. And what I believe is actually happening right now is that we are seeing the markets move through this volatile period near the end of the year through extreme consolidation, while the bond market and bond investors, are basically telling the US and the global markets that, hey, we don't believe you have a handle on this. In fact, we believe you're losing control of the debt market. And there is nothing you can do to stop us from demanding more until you're able to address the risk factors that come into play for the market. And those risk factors that come into play for the market is the amount of money that we're borrowing on an annual basis, and the Fed funds rate. So the Fed funds rate right now is down to about 4.5%. I think we're going to probably have to see this move down to, 3.25, 3.5, maybe a bit lower to alleviate this pressure. And I think if we move the Fed funds rate down through the Fed, maybe making an emergency rate cut between now and say the end of the first quarter, I think the pressure will come off the market. But until then, until that pressure comes off the market, we're looking at, again, as I've been mentioning to you, a dramatic shift. So I'm going to tell you right now, we've actually moved into bearish trending back over here in November. As I mentioned to you, we went into kind of a bearish cycle trend back over here. I'll pull the exact date. This was weekly, so I think it's right around this area. We went into a bearish cycle trend and come back over here. LE back here on November. Let's see, there's the election. It's right after the election, third week after the election. So that is going to be 1, 2, 3 right over here. We went bearish. That's when the system triggered a bearish bias. Okay. And that's basically right here, right on that little blue marker right there. Bearish bias. Prior to that, we had been bullish going into neutral. Actually, we went bearish right after here with the stop exit. So technically, we had been bearish since back in here, early October. So that's going to be back into this area where we had the bearish bias setting up. The bearish bias is indicating essentially that we do not have a bullish bias. So either we're in a bullish bias or we're not. Okay. When we're not in a bullish bias, we can then be in a bearish bias. A bearish bias is indicating that the market fundamentals are weakening, not prompting a strong growth phase, which is again why, if you come back over here and you look at my SPY chart, this is my regular chart. I warned everybody to get into 80 to 85% cash back here in October, late October. And again, I want you to be aware that we're looking at a very strong potential here of rolling into a deeper sideways move. Now, I have over here in this chart highlighted based on these patterns, the cycle patterns, not only these cycle patterns that we're going into with an inside breakaway today in trending mode. Obviously, trending mode is bearish to the downside. We have the breakaway. So now we're looking at a trending mode downward here because we have that breakdown in price. But I need you to understand that we also have this data indicating that we have just come off a top. We're moving into a base today, moving then into a top and a major top on the 18th, and then moving into a peak on the 20th, into strength on the 20th, and then we end up moving through these breakaway patterns on the 23rd, the February 2nd, and then February 9th into a V bottom. So when we look at this, we're looking at February 9th right here, looking at a V bottom. So that's this weekend. Some sort of a big V-shaped bottom is likely going to occur over here. Now we move into that major topping pattern and the base pattern today. So it is very likely that we're going to come down off of this level, reject, move into some sort of a topping formation, roll around into sideways trending before we get another V bottom and attempting to move out of that cycle. So this is why I want to talk to you about this is not the end of the world in the sense that we need to be aggressively shorting the market. I believe that we are going to transition through this move, through the inauguration event, through this sideways kind of a rotational model, possibly filling this lower gap window down in this area today or tomorrow, looking for that base, getting that real rejection back to the upside, and very likely seeing the markets recover back to the upside on an impulse move. Markets don't normally like to go down. That's why, again, I keep telling you guys the market bias is pretty much to the upside generally. But we are getting into weakness, and we should be cautious of our long positions. We should be trying to protect our capital. You should be into 80 to 85% cash. If you haven't taken that advice from literally 3 months ago, then you're going to have to deal with whatever lumps are coming along. And long and short of it, ladies and gentlemen, we're going to be moving into this broad kind of sideways flagging formation in early 2025 for as long as this pressure exists in the market. So you need to understand that my research is very detailed, and in the sense that I wanted to show a little bit of things. So I've been working on this new concept. Okay, right now, I call it the top and bottom indicator. You can see the darker kind of green and red and light red over here. This is designed to catch trends, to help people understand how to catch intraday trends. Now, I'm trying to make it work on everything, which means I'm building adaptive theory into it. But this is a 2-minute SPY. And you can see I've highlighted some things here. Oh, let me show you this one. uh, Price bars change. So you can see I'm using linear regression functions, rolling around, and trying to catch price changes. And what the intent with this is to try to show people where hypothetically some of the best opportunities are for trades. Underneath all of this is an exhaustion system. So there are take profit areas in these uptrends and downtrends for you to be able to take profits. But again, I've been working on this to try to help traders, and I've been building the strategy function into it. This is an example of the strategy. I don't have it working perfectly. Apparently, in PineScript, it doesn't work the way I normally handle live automated systems. Everything appears to be requiring to be a bracket order of such, meaning that you can't just buy, 10 and then place two target orders out there for two at different prices, leaving six as a remaining stop, and then run a 10 trailing stop with it. As soon as I run that 10 trailing stop, it allocates all of my open position and won't allow me to execute the target orders the way I normally do. So I'm going to have to break everything up, rewrite the code, handle everything as bracket orders, which essentially means, in theory, it's the same amount of orders. It's just a little more complicated to work. But the results so far look pretty good. And again, what I'm trying to do with this is, and these are the exhaustion points here, what I'm trying to do with this, guys, is show you how to, profit from the market. So imagine we get into a short trade here, we run down, we hit this target, we hit this target. This is where you need to be pulling, 30, 50% off your trade. Same thing back over here. We get into a long trade over here, target, 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 target. Basically, pull 30%, pull another 30%, pull another 30%. So your trade would go from 100% to 60, and then from 60 to 40, and then from 40 down to, got to do the math, 32, or sorry, 29, 28, and then from 28 down to 20, and then from 20 down to 12, or 14, and then from 14 down to 7. You get the idea. You just basically keep pulling 20 or 30 or 40% off all the way up. Now, ideally, the whole point here is book profits, book profits, book profits until it rolls over and gets stopped out so that you roll over with a very small 6, 7, 8, 10, 12, 15% number here. So you profit, 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 roll over, take a little loss. And this is going to give you essentially a much, in my opinion, smoother equity curve. But you can see how it's designed to work. So this is potentially coming once I get all the logic worked out. In the meantime, like I said, I think we're going to roll and base. So if I were to give you an example of kind of what I think is going to happen here, come back over here. Okay, the price is at the front. Visual order, bring the front. I think we're going to move into kind of this basing mode. And like I said, it could be lower, it could be down in this area, coming back up into the 18th or so. It could try to fill this gap. So kind of right around this area, you can see we have support back here as well. I do believe that we're gonna hold up base and maybe attempt to rally a bit. You know, maybe not that high, maybe only 592, 593, kind of in this area. But this basing mode here suggests that we are going to go into a base mode today, running into a peak, base mode today, running into a major top on the 18th and a peak on the 20th into disruption. So again, sticking to the fact that we are in a bearish trend, likely going to find support over in this area, and then likely try to move a bit higher. You know, in reality, folks, you know, the Fibonacci levels. Let me give you an example. Depending on where we're at and where we find our bottom today, let's assume we find our bottom down here just below the gap, then a pullback level in these areas would be in the 618 area, the 50 area, or the 382 area. Any of those levels would be valid pullback levels. So basically, we could come to here or here or here, and that's 596, 591 roughly. Well, here it is. 595.38, 591.50, and 587.64. So those give you an idea of where we're at. Now, the QQQ, as I mentioned earlier, did not, uh, it did close below the low. What was I looking at? I was probably looking at this. Hold on. NASDAQ. Nope. It closed below the low as well. Was looking at something the other day, and it indicated that we did not have Friday the 10th, Tuesday the 14th, Monday. Oh, this is today's. So yeah, okay, this is trading intraday default New York. Okay, so what was happening is I was looking at yesterday. Let me come back over here to the QQQ. And this is Friday the 10th. Yeah, I was looking here at the NASDAQ. So if you ignore today, back over here, we had not closed below these lower levels. We're looking at getting below it here today. So this indicates again that we had not gotten below, so we could potentially get some sort of a basing mode back into this topping pattern back over here. We're going to have to see how things play out here with the QQQ and the NASDAQ. You know, we do have these critical downward target areas: 20,000, 160, 15,000, 19,563, and roughly 18,950. So we could easily move down into these areas or these areas, this area here. We could easily roll down into these lower levels over time. And that's again one of the reasons why we need to be aware of this weakening, contracting trend. This is really, comes into this again. As long as this pressure is acting up in the markets, we're probably going to get some pretty ugly looking trends. Okay, so now let's come back over to gold and silver. Gold and silver are moving in a resistance mode. We've got a top resistance today in gold and silver, flat down, breakaway, and then rally. Gold and silver, as I mentioned, will likely move into a hedging, a greater hedge for risk. Depending on how the markets react today, I would expect gold and silver to attempt to roll out of this little pullback today, moving back into this area, and then attempt to hedge the risk going forward. Same thing with gold and silver here now, or silver in this case. If we get into some sort of a crisis event, I think we're going to see silver and gold roll down fairly aggressively. But again, gold and silver will be acting as a hedge against risk. We are going to be transitioning through this apex area, and through this apex area, you can see we've already gotten out of this mode. And really, ladies and gentlemen, we got up to the 2720 area. I talked about bit of a pullback is not uncommon. We roll back out of this mode as soon as we clear the 2730, 2735 area. We're going to be up into this 2770, 2780 area for gold. And gold will hedge this risk unless there's some big crisis event. So remember, gold is going to act as a hedge. Silver will do the same thing, but again, it's gonna hedge against a crisis. If a crisis hits, gold and silver will move down strongly because of the crisis, and then rebound and try to move higher. If a crisis hits, like a banking crisis or some other crisis, be prepared. Gold and silver can move down strongly before trying to move back out and higher. Okay, if that crisis doesn't hit, then we're going to be looking at gold and silver rolling through these patterns, trying to properly hedge to the upside. And today, going into the inauguration, I'm going to tell you that, that's one of the reasons why I suggested, I don't want to go too long here, getting into 80 to 85% cash. I'm going to sound like a parrot over here, but there's a reason why I told you to get into 80 to 85% cash 3 months ago. It's because this volatility, I anticipated this volatility, and I realized it would be better just to stay away from this risk, trade much smaller amounts, and look for the opportunities back over here to get back in the trade. Now, what's going to happen as all of these things are playing out, like I'm showing you here with the data, we're getting into this excessive bond hostility where traders and investors are basically telling global central banks, hey, you're screwing up. We don't believe you. We are going to demand higher and higher yields until you prove to us you have this under control. And what we're going to do is we're going to go ahead and we're going to continue to put pressure on the markets overall until you take action to settle this. This is partly because of the end of the spending spree. For the last 20 some years, we've had nothing but spending, actually longer than that. And the fact that, we're moving into the end of the Biden presidency where we have quite a bit of uncertainty and a new Trump presidency. So there's a lot of uncertainty. And now that is leading to this rolling consolidating trend that we're seeing back over here. We've gone through what's going on with gold and silver. We've gone through what's going on with the S&P and the Nasdaq. Now let's take a look at our friendly neighborhood Bitcoin on a daily basis. And here we go. We're getting that big breakdown. Okay. It's doing exactly what I suggested. After reaching this top, coming back down, setting this first excess phase peak, flagging formation off of this low, rolling back down, setting a secondary excess phase peak, flagging formation, joining or combining these areas right here for a big breakdown. We came back down, looked like everything was going to stall. I'm sure everyone was telling you that, hey, it could go up. It's probably going to go up. Look, this is holding. This is now downward confirmation of this breakdown. We are essentially targeting this 74,000, 73,000 area, in my opinion, as long as this continues to break down, meaning that we could see Bitcoin and the markets, the general markets, eventually break downward simply because of the actual breakdown in hard assets. As long as we get this rolling congesting period into the Trump presidency, we could continue to see this play out in a downward cycle trend down here, retracing some of these levels. So maybe not quite as aggressive as this. Could be, I mean, could be fairly aggressive. But remember, we're looking at more of a rolling kind of a consolidating cycle phase, almost very similar to, and if I were to do this, almost very similar to 2018. So come over here, take a look at what happened in 2018. Fed rates were high. We moved into a consolidating phase, and basically we moved into this kind of a consolidating sideways flagging formation here until about the end of the year, middle end of the year, where we rolled out of it slightly. Then we rolled into the end of the year breakdown, retesting these lows again. You can see it's a pretty clean level, and then coming back out of it. So I don't believe we're going to see this at the end of 2025, but I do believe we're going to see this consolidation into the beginning of 2025, rolling potentially out into kind of a consolidated mode in 2026 and then higher. So I think this is a pretty good layout for 2025 and 2026, but I don't believe we're going to see this. I think the Fed is going to be forced to lower interest rates down to 3, 3.25, maybe 2.75, 2.5 to try to take the pressure off the bond markets and to allow traders and the markets to actually function. And that's going to then give us an opportunity to grow out of this mode of, extreme spending. So the Fed's job is to manage a fluid economy. And I would say that right now they've overextended things for too long, and interest rates need to be closer to 2.5 to 3% to go ahead and give us that range. So now we come back over here to Bitcoin. As I mentioned to you, Bitcoin is breaking down. We could get a little bit of a fobble, kind of a fumble right here, rolling a bit, but I think eventually we're going to get down below this 85,000 area and then move down into the $74,000 area. It makes sense that we're going to have to see some hard reset of assets, and Bitcoin could be one of them. The markets, again, the Dow Jones and the industrial, the S&P and the Nasdaq will likely see some downward retracement, as I mentioned to you, back over into the sideways flagging, kind of like I've shown right over here. But I want you to remember, guys, that this sideways flagging into June and July is not going to be excessive, in my opinion. So this is a nice weekly chart. And let's assume that we sideways flagged into a nice solid retracement area here through June. How much is that? How much is that really? That's 9, 10%. That's not so bad, really. I mean, you have to understand that we get 10% pullbacks fairly common. There's 10%, here's another 10%. That's 15, 16% at the end of the bottom. We get these kinds of pullbacks fairly regularly. An 8 to 10% pullback is pretty common. There's 18%. There's 10%. It's pretty common. So getting a nice little 10, 11, 12% pullback going to seem like the end of the world, but it's not. When you look at the longer term picture here, yeah, it's not the end of the world. Just a minor little blip before we move up into upward trending. Okay, guys, I'm going to leave it there for now. And again, we're just kind of like I said, you got to watch our P's and Q's right now. I've been trying to tell you 2025 is going to be fairly rough. And I do take into consideration a lot of other factors. So I want you to be aware it's not just me over here with my cycle patterns doing this research. There's a lot of other data that goes in to try to help you and to try to make sure you're on the right side of the markets. Okay, guys, talk to you later.